Okay, well, welcome to this month's webinar. I, I want to apologize. It's been a couple months since I got about a month and a half since I got the last one out. Unbelievably busy. And the reason that I wanted to get something out is I'm trying to do kind of a three-part uh, webinar where we break it down into more manageable parts. But ultimately, what I'm trying to show you is kind of why are we in an economic funk? So even since the bottom of 2009, our GDP on an annual basis has not breached 3% in any year. It's been very anemic. Most of the jobs that have been created are mostly bartender, waitress, nothing that's really that long term or something that most people would consider to be a career, maybe outside of medical. So it just seems like, things aren't really popping along, although the stock market's done well. That's more of a liquidity issue, and we'll talk a little bit about that. But ultimately, from the last webinar I did, I really discussed what was the root cause of our economic malaise. And I always say I can sum it up in one word, and that's debt. We have just way too much debt. This is a great chart showing you our debt compared to the size of our economy or our gross domestic product, GDP. This includes government debt, consumer debt, and corporate debt. As you can see, at the peak in 2009, we had 383% debt compared to economic activity. So we had $3.83 of debt for every dollar of economic output. It has come down since then. In 2015, as we finished that up, it was about 323%. You can kind of see if you go back in this chart and look at 1933, the peak of the Depression, even then, we only hit a 300% debt to GDP. And a lot of that was due to not so much debt levels, but the GDP was shrinking rapidly. We had almost a 25% decrease in our GDP. So this is a very telltale sign of why we are in just this economic funk. Another great chart that I showed in the last presentation is just debt relative to economic growth. So the dashed line is a per capita gross domestic product in the US. So that's the amount of economic output per person in the US compared to the percentage of debt per capita per person. So you can see the amount of debt that we've been taking on relative to each person in the US and compared to GDP growth has been astounding, really, since the late 90s. So why is excessive debt bad? Well, the first thing, it creates malinvestment. And what I mean here is inefficient use of capital. So take an example of when debt is easily accessible, you could have companies, you could have individuals who continually go out and just bring in more debt to cover up flaws. So, maybe my business, maybe your business, maybe somebody else's business should not be in business. It should fail. It isn't efficient. It isn't meeting customer needs. But yet the fact that they can access the debt markets keeps it going. Well, the problem with malinvestment is eventually that's going to come out and it's going to result in losses. But the other thing that it does is once those losses manifest, companies that are otherwise feasible or should exist because they're efficient, because they address consumer concerns, they can't get capital. The second reason excessive debt is bad is the debt multiplier is bogus. I'll explain that in just a second. And the third one, and it kind of goes with the malinvestment, it leads to a debt deflation and asset price declines, and I'll discuss that too. So I mentioned debt doesn't produce long-term growth. The debt multiplier. So you're going to hear economists like Paul Krugman, other Keynesian economists say that, well, for every dollar of debt we take on, we actually create $1.25 of economic output, sometimes even more. Well, the reality, that's just not the case, especially if it's an inefficient entity like the government taking on that debt. The government is extremely inefficient. When they spend a dollar, they don't spend it nearly as efficient as you do with your own dollar. So what this chart shows you is basically the amount of economic increase relative to each dollar of incremental debt. So yeah, back right after World War II, every dollar of debt that they added actually increased economic activity by $4.61. But by the early 50s through the 80s, every dollar created 63 cents of economic activity. By year 2000, we're talking 24 cents. And really, since 2001, every dollar of debt we've taken on has only increased or turned into 8 cents of economic activity. So really very inefficient use of debt. Next, I'm going to talk a little about debt deflation. But before I talk about debt deflation, I think it's important that you understand how our banking system works. It's amazing how many people really don't understand how the banking works. And it works under something called the fractional reserve banking system. So this chart, while it's got a lot of little graphs and it looks a little busy, it's pretty informative. So we start off at the very top of the graph, the top left. And let's say that's you, that person, that little stick figure there, that's you. You're going to put $1,000 of your money into the bank. Well, fractional reserves means that the bank has to keep some money in reserves, also known as a vault. They need some money in the vault so that if you come back in and ask for your money or a portion of it, that they have something back in the vault to give you. So that's the reserves. But outside of the reserves, what the bank does is they loan out your money. Right now, the fractional reserve, the amount that a bank has to keep in reserves is approximately 10% of deposits. So you come in with $1,000. The bank's going to put $100 back in the vault, and they're going to take $900 and they're going to loan that out. So they're going to loan it to a business, they're going to loan it for a mortgage, they're going to loan it for a multitude of things. So that $900 goes to somebody. So at this point in the system, we essentially have $1,900 in the banking system, and the bank has $100. So the person who receives that $900, then what do? They go to their bank. They pop that in the bank. Well, the bank's going to have to keep 10% or $90. The remaining 90% or $810, they're going to loan out. So at this point, we have $2,710 in the system, in the banking system, and the banks have $190 in the vault. This is all from $1,000. So it all started at $1,000. So then, as you could imagine, the person with $810 goes to the bank, deposits it. Again, we go through that 10% reserves, 90% loaned out. So as this process continues, and it does, that initial $1,000 that you put into the bank all of a sudden becomes $10,000 in the banking system. So you can kind of see there's a lot of leverage here. $1,000 creates $10,000 of cash, essentially, due to fractional reserve banking. So the reason that excessive debt is bad is what happens is you end up in a debt deflationary environment. So here again, if we keep interest rates too low, artificially low, what that does to the individual is it disincentivizes savings and incentivizes debt. So if you're only going to get, like you do today in a bank, if you're going to get less than 1%, why save? Yeah, what's the purpose? Really, what you're going to look at is, hey, maybe I'll just take out a car loan. I can get a car loan at 1.9%. That's ridiculous. I'm just going to do that. So what you end up having is people going to the debt markets rather than saving. In an ideal world, what you have is the savings is what fuels debt. And the two almost have to be pretty equal. So if I put my money as savings and you want to take debt, my savings fund your debt. And what happens is if there's too much savings, then interest rates come down. If there's not enough savings, then interest rates go up. So the savings rate in a normal, healthy, free market economy is going to set interest rates. It's going to put things out there to ensure there's not too much debt or too little debt. With the system I'm going to show you, that's not the case. So anyway, getting back to the point, In a debt deflationary environment, you're going to have too few people saving and too many people taking debt. So what are they going to do with this debt? Well, I already mentioned buying a car, but there's other assets that they're going to buy: a home. They may start a small business. They might buy stocks. They might buy bonds. Well, eventually this cycle continues to go. The debt level continues to climb, and eventually the debt gets harder to get, either because interest rates go up or just the level of debt gets so high that you really can't handle much more debt. The debt payments essentially become unmanageable. Well, once debt payments become unmanageable, then you really have no good options. The first thing you can do as an individual is you cut spending. So if the credit card bill gets too big, well, guess what? You got to cut your spending. Because remember, debt is nothing more than taking future consumption and pulling it into the present day. So you got to cut spending. You already spent that money on the car. You can't afford anything else. We got to cut spending. The other thing you do is you start to sell assets. So all these assets you've been purchasing with this debt, all of a sudden you're going to have to sell that to pay your debt. So the car, the stocks, the bonds, maybe your business, maybe your home. The third option is you just default on the debt. You just can't pay it. So as you can tell, all three of these options aren't good. And when you have this happen on an aggregate level for the economy, it's not good. So what you end up having is assets continue to drop in value as people start selling to cover their debt payments. And it's a vicious cycle. And as you can remember from the fractional reserve example, we have a lot of leverage in banking as it is. So if we ever get to this point where things start to deleverage, well, that 10-to-1 ratio, remember the 1,000 you put in became 10,000. If that reverses, you've got a big issue on your hands. Now, if you think that maybe this is just something that's going on in America, we are very US centric as investors, but the reality is this is happening worldwide. When you look out there, you're going to see that the debt relative to the gross domestic product worldwide is over 300%. So we have a debt crisis worldwide, not just in the US. So what I'm going to propose here is, a lot of people will say, I've got my tinfoil hat on. I'm a government conspiracy guy, but I blame the Federal Reserve System for the situation we're in. I believe that the Federal Reserve is just not needed. It really isn't. As I mentioned before, interest rates can be set from the amount of savings. It dictates what the rates are for debt. There's a natural tendency for free markets to function that way. The Federal Reserve distorts that. And when they distort that, usually what we end up having is a crisis and we have excessive debt. But let's talk a little bit about the Federal Reserve System, because as I mentioned, most people don't understand how banking works. Well, they certainly don't understand the Federal Reserve System. In fact, it was Henry Ford that said if the average American understood how the banking sector worked, there'd be a revolution by the morning. So, I'm not being conspiratorial here. I'm going to show you why I think that this is the case. So basically, there's really three sections to the Federal Reserve System. The Board of Governors, they're kind of the top guys. They're the guys that are meeting. Janet Yellen leads them right now. They get a lot of the press. And the goal for the Federal Reserve System is to control the monetary policy. Congress has given them a dual mandate of having full employment and stable prices. Many people say those are contradictory, but that's what their mandate is. The Federal Reserve regulates their member banks. And the other big thing that they're supposed to do is contain systemic risk in the banking system. So you have the Board of Governors at the top, and then around the country, you have 12 regional banks. You may have heard of, the bank of the Federal Reserve Bank of New York. All these regions have their own central bank, if you will. And then, of course, you have member banks. So within each region, if your bank is part of that region, then, for instance, Bank of America, which is headquartered in North Carolina, in Charlotte, their Federal Reserve regional bank is in Richmond. So all of these banks within your area, living area, belong to their regional bank. So that's kind of the structure. So the first thing that the Fed does is it acts as the nation's central bank. What does that mean? Well, the first thing that you need to realize is the Federal Reserve is actually a private institution with public duties. It is not part of the government. despite the word federal in it. Many people think it's a government entity. It is not. It is owned by the 12 regional banks. It is a private institution. Now, what it really does, it serves as the Treasury Department's checking account. So all the tax revenues that come into the Treasury Department, they plop it over at the Federal Reserve. When the Treasury Department's spending money, they pull it right from their Federal Reserve checking account, if you will. Some other things that the central bank does, it clears all your checks. So when you write a check, it's going to go to your local regional Federal Reserve Bank to be cleared. They also issue our currency. Pull out your dollar bill and look, it does not say anything with the Department of Treasury. It says it's a Federal Reserve note. So the Federal Reserve is in control of our currency. What happens is the mint prints the money and sells it to the Federal Reserve, and then the Federal Reserve manages that. Now, even though it is a private institution, they do pay their profits to the Treasury Department after they take a nice 6% dividend and give that to the member banks. So the regional banks get that 6% dividend. But make no mistake that this thing is being run by private banks. Okay, private banks have control of our money supply. Private banks are determining how our money supply functions. It is not a government entity. The second thing that the Fed does that most people might know is their federal funds rate. This is probably their most important function. Anytime you hear them talking about the Fed, they're usually talking about what's the Fed going to do with their interest rates. They're going to increase them. They're going to cut them. Well, they're talking about the federal funds rate. And what the federal funds rate is, it's the interest rate at which a depository institution lends funds maintained at the Federal Reserve to another depository institution. So basically, it's banks loaning to banks. And let me give you a quick example of that. Remember a little bit earlier, I said that you have to have 10% in reserves at the bank. So you give them $1,000, they got to put $100 in the vault, if you will. So if they fall below 10%, they have to get back up to that 10%. And the way they usually do that is by borrowing from other banks. So let's say Bank A has 15% reserves. It's kind of a conservative bank. They've got a little more in reserves. They're not loaning as much out. And Bank B only has 5% in reserves. So Bank A is going to loan Bank B enough to give them the mandatory 10% in reserves. And then Bank B is going to pay interest to Bank A at the federal funds rate. Now, right now, the federal funds rate is a paltry 0.5%. It's just amazing how there's so much press talking about the Fed raising rates when they're already at almost 0%. They just recently, at the end of last year, went from 0.25 to 0.5. Even if they go up another 0.25 to 0.75, that's really just rock bottom. So that's what banks get when they loan to each other. The Fed's hoping that banks won't hold on to that money and won't loan to each other. They'll put it into consumer loans instead, or corporate loans. Well, this just gives you kind of a chart going all the way back into the 1950s of what the Fed's fund rate has been. That big spike in the late 70s, early 80s, those of you that were adults then remember having mortgages that were high double digits. It's because Paul Volcker, the head of the Fed at the time, there was massive inflation, so he increased the federal funds rate drastically. And essentially what that did is it reduced the amount of money in the economy. Go back to that fractional reserve. If anything happens to where banks aren't lending out as much, they end up keeping higher reserve amounts because it doesn't make sense to loan it out. Well, you have money coming out of the system. So that kind of killed the inflation rate. But historically, if you look at it, the Federal Reserve keeps the Fed's fund rate well below core inflation rate. And that's just not a good thing. That means we're going to end up with too much debt. If we didn't have the Federal Reserve, and this is the case I'm making here, then what would happen is the free market would set the rates that banks would lend to each other. The federal funds rate would just become a natural function of the banks. The banks would look at certain things like, well, what's the underlying credit of the bank I'm loaning to? What's their size? What's their ability to pay? But the other thing that they're going to look at is what's inflation? They're going to want to make sure that whatever they loan out, they're not going to lose money relative to what inflation is. So it might result in higher rates and it might result in less debt, but it's certainly going to keep a debt deflationary environment from happening. And the Fed has consistently kept the core rate that they control, the federal funds rate, below inflation. And the problem is a lot of the other interest rates are tied to what the Federal Reserve does. So eventually, the 10-year Treasury rate, mortgage rates, everything in its from corporate to junk bonds, everything is in a way tied to what the Federal Reserve does. So if the Federal Reserve keeps rates artificially low, we're going to end up with excessive debt. And eventually, when debt gets to be too big, we have the debt deflation. Another function that the Fed is supposed to do is they're supposed to solve panics. They were actually around at our forming as a nation, and then Andrew Jackson killed the central bank during his tenure. And then for about 100 years, we had no central bank and functioned very well, might I add. We had some of our highest growth ever. But then, there were banking panics. We had banking runs. So what ended up happening was in 1913, they came back and started the Federal Reserve. So the reason they did it is that we had a big banking crisis in 1907, and the banks didn't like this because these big bankers were losing money. So they wanted something to back them up in case things got bad. So the first thing that happens is you have the bank sets the reserve requirements. So remember, right now that's at 10%, but the bank can say, the central bank or the Fed in this case can say, well, let's make it 15% or let's make it 20%. That means they have to put more money in the vault and lend out less. So that kind of makes sure that the banks are pretty solvent. The other thing that they really do, and this is the big area that they function, is the lender of last resort. So if banks can't get money, if they're in a crunch, they go to what's called the discount window and they borrow from the Fed. Now, what I always like to say is all these people who support the Fed say the Fed helps with panics and they create a more stable banking system. But we've had the two worst banking crises ever in our nation's history happen under the Fed's watch, the Great Depression and, of course, 2008. So I really don't think that the Federal Reserve is worthy of solving panics. And this is the balance sheet of the Fed after the 2008 debacle. So this chart, it's hard to see things from it, but usually what would happen is if a bank needed to go to the Federal Reserve to borrow, they have to bring in some assets as collateral, and usually that's going to be treasuries. For about 30 years, the Federal Reserve had about 800 billion in their balance sheet, and it was all treasuries, or almost all treasuries, I should say. But what happened was in 2008, we had the crisis, and then the Fed basically expanded their balance sheet to now it's over $4 trillion. And a lot of the collateral they're taking is all the crap that was basically worthless, or at least, I guess you could say, maybe lost half its value or 3/4 of its value. They came with these mortgage-backed securities and all of these other investments and use that as collateral. And what the Fed did, if they came with a mortgage-backed security, if a bank did, and let's say it's really only worth about 25 cents on the dollar, the Fed would say, oh, it's worth $1 and give them that much money. So the Fed has a lot of bad assets on their balance sheet. So the other thing that the Fed essentially did that was completely horrible, and another reason probably not to have it, is it repealed Glass-Steagall. Now, Glass-Steagall, you may have heard about that, but it came about after the Depression when 1 of 5 banks failed due to excessive speculation. Well, what Glass-Steagall did is it separated depository banks from investment banks. So depository bank is what you're probably using most of the time. You take your bank, you put it in a local bank. They're going to hold it. They give you a checking account, things like that. That's a typical depository bank. Investment banks, they're raising money for companies. They're investing their own money in investments. Very different entities. So Glass-Steagall put a wall between the investment banks and the depository banks. So that way, if the investment banks made bad investments, well, the investment banks would go under. but the depository banks where mom and pop are putting their hard-earned cash are still going to be solvent. It also limited the leverage of banks that banks could take. Well, going all the way back to when Reagan was president, the Fed started basically chipping away at Glass-Steagall. It started off with, well, okay, we'll loosen it up so that 5% of the depository bank's revenue could come from underwriting securities, 10%. And then late 90s, Greenspan does 25%. And by the end of the 90s, they completely overturned Glass-Steagall. And then they said the banks, Greenspan, head of the Federal Reserve at the time, said banks could manage it. They do a good job managing the risk. So we had leverage go from 10 times to 20 times. Now, the reason this is really bad is that when, like in 08, when these investment bankers who made horrible investments, when it blows up, well, they go to the Fed and get bailed out by the Fed. And what that does is it just creates a situation where you're going to end up having these kind of crises because these investment banks can do whatever bets they want and have no recourse. Whereas if they knew it was their money and that if things went bad, they went under, you'd have a very different investment environment. Plus, that they can't come at the deposits of mom and pop. So my argument is I don't think we need the Fed. I think we need to get rid of the Fed. The FDIC and NCUA can regulate banks very well. I think that the markets can set interest rates much better than the Fed has. And as far as helping us get through crisis, the Fed is no better than what our free market economy was producing in the 1800s and early 1900s. So what I'm going to talk about next in our next webinar next month is kind of what's the end result. So now we see that we have kind of a low growth environment. I'm saying it's happening because of the debt deflation that we're kind of in. And I'm kind of putting it on the Fed for creating this in the first place. And if you want to do some reading in between then, these are two great books, especially This Time is Different. This was a book that was put out a couple years ago, and it looked at other banking crises and what happens. Essentially, you do see low growth in the economy, which we have experienced, less than 3% since 09. You also see more volatile markets. You also see lower returns in your investments. And this book does a nice job of laying that out. If you want to kind of see the end game of what central bank intervention creates, well, monetary regimes and inflation does a very nice job of doing that. So I do recommend you look at that by Peter Bernholz. But next month, what we'll look at is what is the investing environment in this kind of situation? Where should you put your money? We'll look at things from a historical perspective because I'm all about the history. In the meantime, if you have any questions, please feel free to drop me a line. You can find me at picketfencefinancial.com. You can also sign up for our newsletter or look at all our videos at the site. But if you sign up for our newsletter, you're always going to be informed of when I do a new webinar or something along those lines. Anyway, I appreciate your time. And again, if you have any questions, let me know.